in autumn of last year, the treasury market got pretty disorderly. You started to have yields going up pretty dramatically, and around that time is when they shifted towards issuing more debt on the shorter end of the curve. And yeah, basically that's their biggest tool that they can pull. Another tool that they're planning on doing is treasury buybacks. And that's a less potent tool, but it still can improve liquidity a little bit because basically there's when you issue treasuries, there's on the run and off the run securities. And so, for example, back in March 2020 during the COVID crash, the off the run treasuries basically broke. That market kind of went no bid. That's the less liquid part of it. And so with treasury buybacks, they can buy back off the run securities and they can shape their treasury curve a little bit more. So they have a little bit more flexibility. But overall, that's a less big tool than shortening your duration and pulling all that reverse repo back into the facility. So the other main tools are from the Fed, right? So for example, they can go back to quantitative easing, they can do yield curve control. There's all manner of tools that they have available, but they're kind of like a breaking the glass like emergency set of tools because they don't particularly want to resort to pro liquidity things when inflation is still at or above their inflation target.
In the autumn of last year, the Treasury market experienced significant turmoil, with yields surging dramatically. Lyn Alden discusses the US government's response to this liquidity crisis, highlighting the strategy of issuing more debt on the shorter end of the curve and implementing Treasury buybacks. These buybacks, while less potent, aim to improve liquidity by reshaping the Treasury curve. Alden emphasizes the importance of monitoring the reverse repo facility, which could run low later this year, potentially leading to significant market impacts reminiscent of past events like the repo rate spike in September 2019. Stay informed about the evolving dynamics of the US economy by subscribing and turning on post notifications, like share and subscribe for more insights on finance and economic trends.
Back in the prior scenarios, basically, okay, what happens when the treasury runs into liquidity problems? And the answer was shorten the duration. The next big kind of if else decision point will be what happens when the reverse repo facility gets very low or runs out, which is not right around the corner, but it can happen later this year. And Treasury Fed officials have already talked about that. They talked about the possibility of slowing down their QT eventually in response to the reverse repo facility getting fairly small. That's when you could see, I think the biggest comparison would be September 2019, which was the repo rate spike. That was a macro event that was not very noticeable to retail investors, but that was kind of a big event for macro-oriented investors. And it basically signaled the end of the prior quantitative tightening by the Fed, and they had to go back to some degree of quantitative easing to help with overall liquidity. So I think you could see a similar pivot like that whenever that gets low. But as it gets low, that becomes something to watch fairly closely. Overall, I think most economic indicators are now showing early signs of reacceleration. I would say largely it's fiscal driven, but there's still some troubling spots. So commercial real estate, unemployment's kind of in a mixed situation right now. Some of the global economies are still kind of stagnating. So I think we're in early signs of potential reacceleration. We have to watch to see if it's sustained. And then the next big thing to watch is what happens when the reverse repo facility gets fairly low. And you can kind of reduce the drama by not being in long duration treasuries, right? So, if you want to take on risk, there's plenty of other ways to take on risk. And if you want to be in risk off, or at least have part of your portfolio in risk off, then, things like short duration treasuries or treasury inflation protected securities or other types of defensive assets can largely sidestep the question of what happens when the reverse repo facility gets low or runs out. Yeah, they can always pull out more tools, but I think in general, a fairly large moment would be when the Fed is no longer able to tighten their balance sheet anymore. They can still at that point, if they want to keep interest rates high, but then arguably high interest rates plus no more QT or outright QE would be stimulatory. And so we have to see how they decide to navigate that. We have to see what's happening with energy markets at that time because that's obviously a very important input into overall inflation. So that's kind of the next overall set of things to watch. They're already openly discussing the possibility of reducing interest rates. That's in large part because official measures of inflation have decreased a little bit. So if they want to, if you want to, let's say you wanted to maintain positive 2% real rates and you have inflation going down, you can then reduce nominal interest rates while still staying, say, 2% above official CPI, just as throwing out kind of round numbers. So they certainly have that option. Um, but some of the liquidity dynamics are less sensitive about interest rates and more about just the sheer amount of treasuries coming to market compared to available capital to buy them. Lower interest rates can allow some entities to buy them. For example, can ease banks a little bit, and that they could, something could go back to buying some treasuries, which they're not really doing right now. But overall, I think the balance sheet side is a little bit bigger for macro. And primarily where the interest rates matter is some of those really interest rate sensitive industries. So commercial real estate, especially, unprofitable tech companies that rely on kind of a lot of equity issuance and things like that. And then to less extent, residential real estate, not necessarily in terms of prices, but in terms of just overall volume, like how many transactions are happening. And there are a lot of businesses obviously based on how many homes are sold versus what the prices of those homes are. So there's certainly some sectors where that really matters. I think part of it is I think we're in a high period of I wouldn't call it euphoria, but certainly some areas are euphoria. And it's basically it's also a view like a lot of investors don't know where else to go. They're like, "Oh, I'm not going to go to Europe and invest. I'm not going to invest in China. I'm not going to invest in emerging markets." And so they kind of just stick to quality. I think there's a little bit of a bubble in, ironically, high quality US stocks. So, for example, Costco, great company, but they're trading at like 45 times earnings or something like that. And it's a 40-year-old, retail wholesaler. And again, they're doing great. But in most market conditions, 45 times earnings would not be the appropriate level for that. There's a lot of stocks like that, and so I think that there's multiple factors going into that. I would, despite the fact that I see signs of economic reacceleration, despite the fact that I kind of view the fiscal backdrop as like basically a slow motion crack up boom, I would still be very careful with individual overvalued equities, ones that there's a lot of euphoria baked into. It doesn't mean they have to go down. They could at some point go sideways for a long period of time and fundamentals catch up. But basically, if you want to optimize risk and returns, you want to be careful of things that are already heavily overbought, heavily leaned into by capital, and focus on things that are doing well fundamentally, but don't necessarily have that big valuation bubble attached to them. I think that, I mean, so for example, I think if you want to be in that bullish kind of tech area, I mean, I'm structurally bullish on Bitcoin still. Today it's been kind of bumping around 50,000. And there's kind of maybe some local excitement about it, but I don't think it's really widespread yet. And I have no particular view on what it does for the next 3 to 6 months, but I'm structurally bullish for multi-year view. For some kind of like lower volatility areas, I mean, I generally still find the energy complex pretty interesting. It's profitable in general. It's Many of the balance sheets are pretty good. It's not expensive, and so you basically have this like long-term positive carry exposure to the risk of higher energy prices in the future, and you get paid to wait. That's what I mean by positive carry. So I think that's a decent, kind of a different type of position. I find select emerging markets interesting. So Latin America, for example, certain parts of Southeast Asia, we could see a China equity market pivoting to some extent, but investors have to be somewhat careful about geopolitical issues like tail risks that could occur. Kind of like how if investors were exposed to Russia, the war happens, and then they basically get all their assets sanctioned, and the company is still there. Just your claims of them are contested. So there's tail risks that things like that could happen to China. But basically, wherever capital's not heavily exposed to right now, but that still has decent fundamentals, I think are fairly interesting. I think that there's some of the kind of, if you look at, for example, the S&P 500, the normal one is market weight. There's an equal weight version, which sometimes outperforms and sometimes underperforms. If we do get a period of sustained economic reacceleration, then that equal weight one, which did way worse than the market weight one last year, could play a little bit of catch up. So there are many equities out there, either domestically or foreign, that are not that expensive, even as other ones are. There's kind of a bigger than normal valuation gap between different types of equities. And so that's kind of how I'm viewing it. When I take on volatility, my preferred way to express it is Bitcoin and certain other select equities. And when I want to be defensive, it's things like short duration T-bills, it's tips, it's gold, it's certain defensive sectors.
In today's discussion, we delved into the intricacies of the Treasury market's response to recent turmoil, with Lyn Alden shedding light on the strategies employed by the US government and the Federal Reserve. From shifting debt issuance to implementing Treasury buybacks to the looming concerns around the reverse repo facility, Alden provided valuable insights into navigating these complex financial landscapes. As we anticipate potential market shifts and economic accelerations, it's crucial to stay informed and vigilant. Remember to subscribe to our channel for more updates, like this video, and share your thoughts in the comments below. Thank you for watching, and until next time, happy investing.